Okay.
Reverend Kathy, were you able to receive the information, the charts and
I have that all due. I can share my screen.
Okay, perfect.
Just tell
I
me
can do
what
it.
you want.
Yeah, so if we just start with the one, I'll give just a very brief overview. So to keep you guys on track, I'll just share one slide on that big deck of slides that you receive. And it's going to be number 5.
Okay, so
on the one that says Guide to Markets.
Guide to Markets, gotcha. And then what is it? Did I lose you? Okay. So then where do you want me to go?
Page 5 on Guide to the Markets.
My connection is very unstable.
Okay. Well, I mean, it's one that I can talk through it as well, so that.
Okay, I'll do it. I'll try first. What
Okay.
page again did you say?
It's page 5 on the one it's a PDF that's titled Guide to the Markets.
Okay, I think this is it. Let me.
I will interject here. Nick, you can click share screen and it'll ask her to let you do it.
Okay. We got it. Perfect. So this one right here is, so we've had a strong year in the market, and what we're seeing now is this is a chart of the valuation of the market over the last 25 years. And so in periods of time, there's euphoria, and in certain times in the market, there's desperation of, that the world is ending, basically. And so markets are affected by consumer behavior and investor behavior. And so over the last, you can see the chart is going up and down. That middle dotted line represents the average valuation of the market. And we call the market just the S&P 500 as measured by. And so, so what we have here is that over time, the investor has been willing to pay 16.78 times earnings for dollars, for $1 of earnings. So they're willing to pay $16 for $1 of earnings. But you can see over time that's fluctuated, where in the late 90s, when there was a tech bubble, the market traded at 24 times earnings, which is a 50% premium to the long-term average, because everybody's euphoric and they thought the market was going to go straight up. That's when it peaked. And then 10 years later, it bottomed with the financial crisis. And so what happened over that period of time was that earnings kept getting better, but price kind of stayed the same. And then we had the financial crisis, and earnings dropped, and stocks were really cheap, but no one was willing to buy them because everybody was terrified because of all the volatility, during that period. And so you actually had a really, really cheap market, but it was because no one wanted to buy stocks. And so since then, the earnings, the P/E ratio is what we call it, has continued to increase. Earnings have gotten better, but price has gone up faster, expensive market. And so here we are now, and this is at the end of September, and now it's slightly higher than this, but on the right-hand side, you can see that we're currently right around the upper range of the PE ranges, or one deviation above the average. And so relative evaluations are a little market. And so it's not necessarily a great time to necessarily back up the truck to be buying, because again, you want to be careful in valuations. And they do look a little stretched. Certain areas are more stretched than others, but as a whole, markets appear to be a little bit expensive. With that said, if you compare it to the bond market, they actually look quite inexpensive because bond yields are so low. And so right now we have a market where the economy is still improving, coming out of this recession that was caused by the pandemic. Yes, we think it'll be choppy. Yes, we think that inflation might be a little bit more than transitory. Yes, there will be additional supply chain issues to make this rocky and as we go, but we still think that overall the trend is higher and the economy is still growing, and will continue to do so. It won't be without bumps, but we think that again, as economies still grow, markets can also go higher as well. And so we've had a really amazing run. We wouldn't be surprised if we get any type of pullback or some kind of sideways breathe a breather, but in general we're still optimistic. And so our allocation is we think you can stay the course, so but we wouldn't necessarily be using, saying, coming with a recommendation to get more aggressive at this point. We think that you can own what you have, you can stay invested, but we don't really want to press the gas at this point, if that makes sense. And so then other than that, so that's really the one page I wanted to share with you, is just from a valuation standpoint of the market. In a vacuum, this looks a little bit stretched, but in the backdrop of where we are, this will stay elevated because there's nowhere else really to go either. Cash doesn't pay anything, and you're actually losing purchasing power because of inflation. Bonds don't pay a whole lot, and if interest rates go up, you actually lose money. And so stocks still seem to be the best option. And so we do think that this PE ratio may even stay elevated for a period of time. So just I guess to no one's surprise, I would think that we've had a great run in the market. We don't think it's necessarily over, but we do think that because the markets have done so well, they do need some type of breather at some point, and we would expect maybe some slower positive growth going forward. Thoughts, questions on that at all?
To what end do you transition to safer?
It's tough, because I think if there are signs that, so to answer that, if it looks like a recession is coming, then you might make the decision to say, yes, let's pare back some of the equity exposure. The reason why you would do so is because big drops in the market. So anything market fluctuation, you just kind of have to accept like a 0 to 20% move in the market, peak to trough. That's just kind of normal as far as market cycles go, and market volatility goes. It's just kind of, that's the price you have to pay to be, to receive those gains long term. Historically speaking, drops larger than 20% have also been coupled with recessions. And so it's really a recession that if it looks like there's an oncoming recession, that's really, historically speaking, the time where you would want to be dialing back a bit to try to protect some of those assets. Again, there's been a couple of instances in the last 75 years where the markets have gone down more than 20% without a recession, but they're very few and far between. Ones like the Cuban Missile Crisis, and I'm trying to think of others. Black Monday, 1987, when the market fell like 20% in a day. But it's very, very few periods of time. So again, you pretty much want to kind of stay the course long term. If you are making some of those tactical changes, again, you want to make very few of them because, again, markets tend to go up 75% of calendar years. And so there's only in certain periods of time when it looks like we're heading into a recession, it might make sense to kind of dial that back to be on the, again, this asset allocation is partially governed by the investment policy statement, but there's range investment policy statement of where you can be. So in that case, if you're in the middle or if you're in the high end of the equity exposure, you might want to dial it back to a lower end at that point. But that's about it.
And this is Mark. I mean, we gotta keep in mind, this is an endowment, correct?
Yeah.
And it's meant to be around in perpetuity. And so it's not really about timing the market, it's about time in the market, correct? I mean, so.
Yeah.
So
Yeah.
unless you really see the world coming to an end, you don't
Yeah.
necessarily have to position.
Yeah,
Like-
and I think exactly, and I think in a lot of these cases, again, if we're doing this annually, we want to keep the allocations honest and make sure they're within ranges, which they absolutely are currently as well. But yeah, that's really why you have an investment policy statement, is to, again, keep you kind of grounded to the long term. But right, I mean, I think that's still a good question, though, of saying, okay, we've had this great run. When is there a time? But simply to answer it is, I think you kind of let the markets do their thing. When there's a recession, because there will be, but then it's a matter of, okay, do we have the conversation of, do we pare back? And if so, maybe it's moving from 55% stocks to 50. The investment policy statement won't allow for going from 55% stocks to 0.
Right.
So it's going to keep you focused on the long term anyway, but I think that's still a good question given the environment.
In the past, you have, in past annual meetings here with you, you have sometimes trimmed underperforming
Yeah.
Mutual funds or whatever. Do you see anything that needs to be adjusted one way?
Not
or
really.
the
We
other?
can, Reverend Kathy, if you don't mind, you can go to either one of the other reports to pull up the other two, and I don't have it. I'm working from my laptop because I can't use Zoom through my work. Yeah, this one's perfect. So I can actually just go through the report for you real quick, and Mark, I'll answer that at the end, because
Okay.
what you're going to see is you don't really have anything underperforming. So that's a really good problem to have currently.
Yeah.
If you wouldn't mind maybe going one more page. Yep, right here. This is the Trinity portfolio. And on the left-hand side, the asset allocation with that pie chart, and you're going to see it's about 59% stocks. And so we are well within, boundaries. And then again, what this isn't taken into consideration is that we just raised a little bit of cash because the next distribution goes out in a couple of days. And so that's going to be lowered a little bit. And so we're closer to the higher end of that investment policy, but you're still within the limits. The other thing that's kind of amazing is why you want to think long term. Investment over time, and then the shaded area is the value of the portfolio. And so at this point, the foundation has spent all of the initial principal and $100,000. So you guys are at net negative $100,000 invested, yet there's an investment ending value of $568,000. And that's really, again, at the end of the day, that's how you want this to work. You want to continue to take from this in perpetuity. And again, at this point, you're spending, everything you're spending at this point is just all market gains. And hopefully that just, continues forever. And so that's what you're witnessing. And that's a sign that that's a successful, that's a very successful foundation. In that portfolio return and relative to the primary blended benchmark, you guys are up 12.46%, and that is through December 8th. And then the blended benchmark, which is 55% equities. Actually, I'll get it for you. 5% cash and then 40% bonds. Again, this is per the investment policy statement, is up 9.14. So you can see that you're outperforming the the benchmark by about 332 basis points, which is very, very strong outperformance for the year. While what you'll see is that while the equity managers are doing well, the bond managers are doing exceptionally well, and that's helped creating a really big margin of outperformance in the near term. The 1-year return has been 13.95% versus the blended benchmark of 10.05. On a 3-year annualized average, the portfolio is returning 12.43, while the benchmark is at 12.61. So we're just slightly under. And then over a 5-year period, your annualizing returns, so these are annualized returns of 9.62% per year versus the benchmark of 9.54. And so over time, it's been pretty successful. The markets have done well, but the portfolio has been positioned well and has done a nice job as well. Just one last comment on this page, unless there are questions. We started the year with a portfolio value of $550,768. We've had net distributions of $47,547 for the year. Right now, the current spending is we're distributing about $11,480 per quarter for spending, and then I'm assuming you guys will come up as soon as we have the year-end values. You'll come up with the new spending based on the spending policy, and then yeah. So you're right. As of this year, you're taking out a total of about well, you can see it right there, about the 47,000. And so everything's done really well overall. Any questions on this page? Otherwise, I'll touch on maybe 2 more pages here. But everything looks really good. Any questions at all? Okay, so then if we go to page, let's see here. All right, let's take a look here. So the next page to look at would just be page 11, please. Yep, perfect. So on this page, you're simply showing is going to be it's going to be mostly in large cap stocks, but there's still a little tilt towards growth. Growth has outperformed value over the last several years, and it's been a slight tilt towards growth. As we've actually managed the allocation. So as we've taken the distributions quarterly, we've also used that as a way to kind of rebalance the portfolio as well. So we're leaning slightly on the growth side, but very heavily on the large cap side. So large companies are going to be your blue chip companies that are going to be a little less volatile, and we think that that's prudent for the assets over the long term. On the bottom, you're just simply seeing the blue is going to be representing the Trinity, and then the crimson is going to be the S&P 500. And so you can see here that you're a little light regarding on tech stocks. That's been a little bit of a headwind for you because tech's been so strong. But while it's been our favorite asset, sector for the portfolio, we're still underweight tech. And tech does look a little expensive at this point. So while it is still a large allocation in the portfolio, we're certainly underweight relative to the markets. But overall, for the church in perpetuity. And so it just kind of gives you a gauge of how you guys stack up relative to the benchmark. If on page 19, you'll actually see the performance of the funds. And I can go through this and you'll get a pretty good feel for, where that outperformance is occurring. So what you're seeing here, if I start from the top to bottom, you're going to see the bold is going to show you the asset class. The other font is just going to show you the fund, and then below that in italics, it's going to show the benchmark we're comparing the fund to. So for example, here, Artisan Partners is just a foreign international fund. It's up 14.87% this year, and its benchmark is up 6.99. So they're having a phenomenal year. The fund underneath that, MFS, that's also an international fund. It's more growth related. That fund is up 9.71. The international growth index is actually up 4.88. Again, significant outperformance. They're doing a really nice job. Like I said, some of the big outperformance is the bond side. So for example, here in the middle of the page, you'll see US multi-sector bond. It's been a difficult year in the bond market. So PIMCO is up only 1.82% this year, and Loomis is up 3.54. But that's actually a big win because the bond market, which is measured by that Bloomberg US Universal, bond market is actually down. And so because interest rates are going up, when interest rates go up, bond prices go down. And so if you just owned the bond index, you'd actually would have turned, $1. Excuse me, $99. And so your bond funds that even, we haven't made a lot of money with the bonds this year, but positive performance is actually pretty tough to come by in that arena. And then beyond that, just touch on the bank. Well, yeah, so then below that, you can see even the world allocations, the Thornburgs, the First Eagles. They've been okay for the last several years. They lean a little bit more on the value side, but as the value side is starting to pick up, they're starting to pick up as well. So they're up 11 and 17.5%. And that benchmark is up, again, 8.78. So they're doing exceptionally well. On the other, below that, you'll see the US bank loan. That's a little bit of an inflation hedge. So again, if there is inflation, we would expect interest rates to go higher and bond prices to go down. And so that's what you're seeing a little bit this year, which is why the bond markets are down. But this fund, as interest rates go up, it keeps ratcheting higher and receiving the higher interest rate, which protects your price. And so this fund's actually up 5% this year. And so again, when you have most of your funds making money on the bond side, while the bond market's down, it turns into a big, it's a big deal. And then lastly, the large cap growth fund, AB large cap growth, it's up 27% this year, which is right in line with that space. So, and if you don't mind, if you could just go to the one next page, that's just the rest of the funds in that portfolio. Again, mainstay is a bond fund up 2%. So again, your worst performing bond fund is up 1.82, and your best performing bond fund is up 5, and the bond market is down -1.32. So that's a large reason you're outperforming your benchmark so significantly. And then other than that, when you're looking at all of the other equity funds, you don't have a single fund that's underperforming their benchmark year to date. they're all either within their benchmark or within line with their benchmarks or beating their benchmarks, and some of them handily. So this is really fun because you don't often see that. Usually there's a manager, all good managers will underperform at times. So the fact that, that everything is either in line or significantly outperforming, it's kind of, it's a good year. I mean, it just doesn't happen very often, and everything's really firing on all cylinders. I mean, so the market's helping, but then the managers are adding value on top of that, and so it's been a really solid. Thoughts, questions there? If not, then you could just, if Reverend Kathy, if you don't mind, you can pull up the Eagleston. I get it wrong every time. I'm gonna have to start making donations to that fund every time I call it by the wrong name or I mispronounce the name, I think. But that one, same thing. If we just look at page 5, I think we can pretty much cover that. But this one's up, still beating the benchmark, but just slightly less because the allocations are slightly different. So this one is up just a shade under 11%, while the other one was up a shade under 13%. But again, over time, very similar performance on a 1-year basis. Slightly underperforming the Trinity account on a 3-year basis and a 5-year basis, but they're very similar in nature. When I look at the holdings that are different, there's we have Lord Abbott Bond Debenture Fund. So we have one other bond fund. Yeah, I mean, it's very similar in nature. So the allocations are just slightly different, but you have a very similar portfolio, and it's also doing very, very well. Similar story here. You can, on the upper right-hand side, you can see that, again, as you take out distributions on a quarterly basis, that net initial investment continues to decline. And so, there's still $13,000 of net initial investment from that initial $99,000 or $100,000 that went in. But very soon, not quite, maybe even at the end of this next year, you'll have a same scenario as Trinity, where you've now taken out all of the original principal, and now the foundation is simply running on, the endowment's running on pure investment gains that you've made over time. And so, yeah, this is really the same scenario. You have one different fund. Instead of McKay, which was up 2%, you have Lord Abbott Bond Debenture, and this one, which is up 2.68. Other than that, you have a lot of mostly the same funds. You don't own Thornburg in this one, which you own in the other one, which was up 17%. So that is probably about most of the change, most of the difference in performance. But like I said, it's very similar. So if I go into too much more detail here, it's basically all going to be redundant because, again, it's a very, very similar portfolio. So with that said, I don't have recommendations or changes because everything's performing really well. The only thing that we would need from here is, once you guys meet and at the end of the year, you need to determine what the new spending policy is for the new year. And then from there, we would continue to just trim assets as we need to raise the cash quarterly to be able to make your distributions. But as of now, there are 0 red flags from a investment management or a fund standpoint.
Question on page 12, if you don't mind, can you detail some of those?
Absolutely.
Of this report?
Either one, this or Trinity, page 12.
Do you mean page 11, maybe, Ryan, on the other one, or is this the page you're looking for?
The snapshot, I'd like to understand a little bit about what's going on with these here
Yeah.
Sudokus.
Sorry, which part would you like to know?
The Sudokus.
Oh, yes. This is, yeah. You know what? I've never heard them described that way, but I knew exactly what you're talking about. Yeah. So what this is, so I showed you the same chart, but in a different way. So it was shown on page 11, but it stated the asset class and the percentages. But this is another way this is kind of like a heat map, so to speak. So if you're looking at the blue one, that's the one that's representing the equity map. And so on the right, on the boxes going across, that's going to be based on size. And so the top boxes across are going to be large companies. The middle ones are going to be mid-sized companies. And then the lower box are going to be the small companies based on market cap of each stock in the US. And so they rank them based on size. And then they are split into these boxes. And then on the left-hand side, you're going to get value stocks. On the right hand, you're going to get growth stocks. And then you're going to get, on the blend, you're going to get stocks that are going to be a kind of a combination of both of those characteristics. And so value, you're typically going to see more like utility companies. You're going to see consumer staple companies like a Procter & Gamble or a General Mills. Colgate's, you'll see energy companies in general. You tend to see bank stocks in general. Those are the types of stocks you traditionally see in value. It's not as black and white as that. So it's a little bit more nuanced than that, but that's in general how it works. On the growth side, you tend to see tech, certain healthcare companies, communications companies, so like Facebook, consumer discretionary companies, which would be, Apple and, Visa and PayPal and other, Starbucks, et cetera. Those tend to be the growth side. And so
not to interrupt you. I don't understand. So the horizontal axes, I understand the shading, right, is the key down below, but what is the horizontal axis?
Yeah, so it's saying, so let's take, for example, the 11, 31, and 29 that across the top. 11% of the equity exposure is going to be in large cap value stocks. 31% are going to be in what's called large cap blend, which is going to be kind of characteristics of value and growth for a stock. So for example, you might see like Berkshire Hathaway. So even though it's a financial company, which would traditionally fall into the value side, it also has some growth characteristics that, based on Morningstar, who builds this report, they define them as a blend. So they get stuck into that middle box. On the 29%, that's going to be large cap growth. So that's going to be Microsoft, it's going to be Apple, it's going to be Amazon, and so forth. And so that represents the percentage of the equity allocation in each one of those areas.
Okay. Sorry, I don't entirely follow. So can you run?
So 29% of the equity exposure in the portfolio is in large cap growth stocks. 11% of the exposure of the equities. So again, the equity exposure here. So right now there's 60% of the portfolios in equities, and of that 60%, 29% of it is going to be large growth. You can see at the, like right below those boxes, you'll see on the right-hand side, it'll say growth, and then it'll say blend, and it'll say value. And then on the upper right-hand side, you'll see large, mid, small. You just kind of have to go across, and it represents the percentage of the portfolio in each of those spaces, basically. So we have 5% of the portfolio in small cap total. 1% of it is small cap value, 2% is small cap blend, and 2% is small cap growth. Mid cap, we have 2%.
I see. Okay, I do understand now. I didn't, pardon.
Yep, no
I
worries.
caught it.
Okay.
So
Yeah, so that is, it's not, well, unfortunately, it's not super pertinent for the, well, yeah, I guess it works. Hold on, let me just look at. So it's going back, what this is trying to do, it's based on, yeah. Yeah, so what it's showing, that's just showing relative to the benchmark over a 10-year period. And so that's showing the start of like, that's basically the performance relative to the benchmark over the long term. And so the 10-year return on this portfolio has been 6.86 per year. And then the benchmark has provided 8.36. And so the red line is your performance. The blue line is like the benchmark basically. So at times you will like get closer, or at times you've been beating the benchmark. At times you've been under the benchmark. Right now you're under the benchmark on a 10-year average. But like I said, over the last couple of years, you've been kind of closing the gap, so to speak.
well, so what is investment activity? Is that trades per se, or?
No, I just think it's I just think it's a poorly named, graph basically. What it's representing is your performance relative to the benchmark over time. And so that's
Okay. We'll look into it a little bit. I appreciate it.
yeah.
Okay, I appreciate it, Kathy. That's all I had.
Super. Okay. But overall, like I said, it's been a great year. As we look at markets next year, our expectation is that, we do believe the economy continues to improve. We do see choppiness. We don't think it's going to be, necessarily smooth at all times. But because we're not going into a recession, we don't believe we're going into a recession. Our advice would be to, certainly kind of stay the course. There are no red flags from an investment standpoint. We would expect, like I said, some choppiness because, other than January and September and part of like November, we've had a very, very resilient market, and some volatility would actually be the norm. The lack of volatility right now is actually the part that's not normal. So we think that stay the course. Everything looks, there's not a whole lot to report right now. Everything looks good in the portfolio.
Nick, can you make a comment? What do you see inflation doing?
I mean, that's a great question. I wish I had a better answer, but I think simply, I think there's some inflation that's here to stay, and I think there's some inflation that's transitory. I think as certain wages are increasing, and it's going to be difficult to lower those, and so that's part of the wage, or the part of the inflation part that might be more long term. I think there are some things like cars and automobiles that go into the inflation number that will adjust as supply chains get sorted out over time. So unfortunately, I don't mean to take an easy way out, but I think that yes, there's going to be some inflation, more persistent than we've seen in the past. Yet, I think it will slow down. The rate of that inflation will slow down.
Of course, if we knew what was going to happen, we'd be rich.
There's, as far as the portfolio is concerned, I think we've hedged ourselves well for inflation. So you own things like floating rate bank loans in the portfolio, which again are up 5% this year in a bond market that is down 1.32%. Stocks tend to provide positive returns in inflationary periods. You don't own precious metals. You don't own commodities. They tend to do well, but they're super volatile and you can take big swings there. So I feel like you're relatively there have been steps taken already so that you are sort of hedging the portfolio that, and again, we've had inflation this year and the portfolio is doing great. So I don't think that just because of inflation, you guys have to do a 180 and make, tons of changes. But it's certainly something that it's something we're watching closely and I think we'll continue to watch for a period of time.
Thank you for your comments. Appreciate it, Nick.
Okay.
That's all I have.
Excellent. Oh, Mark, I think you're on mute.
So my question is concerning stock that's donated to Trinity. So I was talking to your assistant and I donated stock here last week or whatever. I see that it did get into the Trinity fund. And then will that be liquidated or that's what our gift acceptance policy is to liquidate that.
Yep.
And then that money will be sent to deposit to Trinity.
Yeah.
Correct?
Yeah, it's not a problem. Yeah, we would just put it into the account. Again, we would be able to do the trade for free. Once it settles, you give us direction on what to do with the assets and with the proceeds, and we just send it from there. It's not a problem.
Yeah. What is the basis as far as for the donation? Is it on the day that it got into the account or is it when it got liquidated?
No, so for the donee, the reason they're likely giving highly appreciated stock to get it,
Right.
Because they don't want to pay the tax on it. But the beautiful thing is that once you sell it, you're not paying the tax either. And so because it's going into the foundation, you guys aren't paying the tax on it. So it's kind of a win-win for everybody.
Right.
And so it's kind of a non-event from a cost basis standpoint.
Okay. Good. That was my question. So on the 15th or so, this week sometime, then we'll get the fourth quarter distribution for this
Yep.
year
Correct.
from both
It's
funds.
scheduled for the 15th, I believe.
Yeah. Okay. Cool. That's pretty much all I got.
Anything else from anyone?
Nope.
Nope. Nick, any final comments?
Thank you very
No.
much, Nick.
I think I've summarized it. So I think we're in good shape, and we'll, if something pops up where something is immediate, I'll certainly reach out to Dan and be proactive. But again, it's a long-term game, and so I think you have high quality funds, an asset allocation that makes sense for the long term. So I think we're good.
Okay. Well, thank you so much for taking your time and doing this with us.
Of course.
Thank you, Nick.
All right. Well, you guys have a very Merry Christmas, and I'll be in touch.
Thanks.
Thank you.
Bye-bye.
right. So long.
Okay. Okay. There, as I'm looking for this. Yeah. So, next thing is for Mark, if you have any, comments on our financials to date.
We're in a pretty good position.
I'm having a lot of trouble hearing you, Mark.
Yeah, I
Mark, are you
said,
using a tin can?
pardon me?
I say, are you using a tin can by chance?
No, I'm not. Anyway, I guess I could, does it help for me to yell louder?
Yes,
It
Okay.
does.
Yeah, it seems like we're in a pretty good year-end position. We've got another, I think, $15,000 coming in this week. And we've got about $40,000 in the checkbook right now. So I don't have the financials right in front of me, but
Is there anything in particular? I can pull them up.
well, I can pull them up too, but I think we're a little bit, we are running a deficit. Like we predicted, but it's not-
You're gone, Mark. We can't hear you.
Oh. Why is that? My lips are moving, but you can't hear me.
I just bought a fancy new microphone a week ago. Cost me $40.
Well, yours is working better than mine, apparently.
I wonder if it's where you are speaking, because as you turn your face, you kind of come and go.
Okay, is that any better now?
Yes, it is.
It is.
Wow, okay. So I won't look at the screen. I have two monitors, so I was looking at my bigger monitor. But anyway, we are, I think we're pretty much on track to probably end up with not quite as big a deficit as we projected. But we'll still be counting on some pretty good gains next year from the I don't know, I'm not sure where the pledges are coming in for next year, but I do think that the endowment probably is going to provide about the same amount of money as this year, very likely.
Okay.
Dan and I and probably Ryan and anybody else that wants to get together with us, we'll have to get together and form a budget here now.
Mhm.
I'm going to be gone to Hawaii on January 12th, but I think we've got another meeting scheduled on the 11th, maybe. So hopefully Dan will be feeling good enough to help me with the budget.
Yeah.
Ryan and I kind of plugged some numbers in from this year, but we'll have to tweak every one of them.
And I've been preparing numbers as well.
Good. Okay.
the meeting scheduled for the 10th, Mark, Monday.
Yeah, it is. Okay, good.
Yeah.
All righty. I know there's Dan wanted us to kind of discuss Kathy's compensation here.
So
You know,
what that really involves is that it's the vestry's desire that the rector be funded at the diocesan minimum.
Okay,
And so that goes on record that that's the vestry's desire.
Sure.
And then we go from there.
right. What, just for, what is that now?
It is, I have it right here.
You are how many years in?
Well, what's your question?
You're at the top, you're over 18 years now. So
Yes, so 81,000.
81,347.
Yeah.
Okay. All righty.
Yeah. Yeah. So that's where we start, and then where we finish is what we can afford.
Well, we'll see. You know, I mean,
So as far as pledges go, we're got a handful in. There's still quite a few that are not. So we're gonna just have to start getting on the phone and making some phone calls and reminder calls to have people take care of that business. There will be some we will not be getting this year because of people moving away. So we've in the office kind of been tracking that, what that means. And sort of people aging out. That's beginning to happen as well. Yeah, I'm just looking at the Excel spreadsheet that Lisa Marie is keeping. And yeah, like I say, there were 4 in the office today when I brought the mail in. So other than that, we're just gonna have to make phone calls and get people to get them in.
you know, Ryan had talked about wanting to get a budget line for the garden. That he has been funding that himself for pretty much for the last few years.
I have a few thousand in it now, I'd tell you.
Okay,
Right.
well,
And
again,
so-
we'll see if we can afford it.
Technology needs some, as you might be aware, Kathy, allotment too, because the Wi-Fi, at the very least in the office, that's connected to the printer and things, is kaput.
No, it's working great. In the
Well,
office is working great.
The one you have now, the interim fix that we've kind of repurposed, but there is one on the fridge that was the Wi-Fi that is,
But we don't need it because everything's working just fine.
well, that you need at least it to be rearranged. The printer is going through that thing that's faulty, and all the wired computers and things, and that won't last forever. That's all I'm trying to tell you.
Okay, well, we can talk about what that means. But yeah, I mean, we always, as we budget for technology, we need to know these things.
Kathy, did the rhyme guy, did Kurt Terry get over there?
Oh yeah, he had lots of answers. So the bottom line is for what
Answers or questions?
what?
Answers or questions?
No, he did fine. What it seems like it happened. So you hadn't been on that computer for a good month.
Okay.
And he pretty much believes that it just timed out. So once I got back on it, so I'm just gonna have to go into it like once a week and wake her up and just put in the password and then everything is fine. It's like he said it's a security thing.
Oh,
So that if it's unused, and it was unused for a good month. Therefore, once I put the password in when we chatted, then
Right.
stuff popped immediately.
oh,
So I'm just gonna have to remember to do that once a week.
sure. Okay.
That's an easy fix. Then he got my my laptop back online with the printer, so that's all great too.
Good. Okay.
Yeah. He jumps when you call. He doesn't jump when anybody else calls.
I don't know why that is, but yeah.
Yeah.
I did mostly all those sandwiches I took him for his golf outing.
One other piece of news, I think you know this, Mark, that the Diocesan Assessment is the same.
Yes. Yeah,
So
good.
I do believe that we'll have to, when we look at 2023, the diocese isn't going to be able to keep that constant as they have for the last couple of years. But for 2022, it is a constant.
I haven't found out what happened. Did something happen with the finance, with the treasurer and Huddleston? And
Oh, he just retired.
he retired, okay.
Yeah.
Because I was also getting some news that, they had to switch their accounting program because they found that a lot of irregularities had occurred in the finances of the diocese, but you know anything about that, or?
Yeah, I don't think we're talking like legal.
No, I'm not meaning to imply that, but
Yeah. And
things
there's also some,
bills weren't getting paid or sent out, or
yeah, there's some interesting, I don't know if the word is software that that the desire of the diocese is for us to use. So we can look into that.
okay.
That, yeah, won't cost us. Yeah, just
Yeah,
for
yeah.
us to be a part of, and then information gets shared much more seamlessly. So what do we have to, I mean, we're going to need to do some work between now and our January 10th meeting. I have some numbers, so I think, Mark, the best thing is for me to get those to you and just kind of start plugging away and seeing what we come up with.
I mean, it'll be the first week in January, once we know where we end up for the year.
Yeah.
I mean, I can watch football on New Year's Day and
Then do this stuff.
all day. That's what I do between this and the deli, trying to get out of here to Hawaii. So I really put a lot of time in.
Yeah.
So I'll get it figured out and get those.
Well, so your priority is end of the year.
Yeah, I mean, because we still got a bunch of bills that we got to square up,
and then secondarily is getting ready for the next year.
Right.
Okay.
But it's doable.
Okay.
I have a word on
I think we'll have the annual meeting on January 30th, the last Sunday of January. Does that work with you? I haven't published that. I just am.
Yeah, I'll still be in Hawaii, but I can zoom in.
You're not coming back until, I mean, because we could go by our bylaws into the first 2 Sundays or the first 2 weeks of February.
No, I won't be back
Okay.
till February
Okay.
25th.
So I'll leave it like that. Okay.
I'll put some clothes on in the video. I saw the old video the other day looking through my computer. I did have a swimming suit on, but well,
Okay.
anybody got anything else here right now?
I had a quick word just for
Yeah.
give you a laugh if nothing else. Apparently the president of RBC was indicted by the FTC or however, no, the SECC.
SEC.
Yes,
Securities
the SEC,
Commission?
that's right. Securities and Exchange Commission. So maybe want to keep that at least in mind a little bit or something.
Well, I think that they've done an outstanding job for us for the 20 years and at a very reasonable price.
Yeah.
I mean,
Yeah.
25. I heard they're cheap. I would agree.
Yep, I agree too.
Yeah.
Yeah.
And thanks, Mark, for all your efforts. I
Yeah.
Oh, you're
appreciate
welcome.
all the work you put into it.
Thank you.
You're welcome. You're very
I
welcome.
got a couple check requests coming to you ASAP.
Okay,
So.
yeah, if you want to make sure they get scanned. I saw that, some of the stuff that got scanned really wasn't pertinent for me. It was a couple of flyers.
Maybe those were our test scans
That
when
might
we
have
were
been
trying
it.
to figure the thing out.
Got it. Okay,
Okay.
good.
Okay, thanks so much.
Thank
Take care,
you.
people.
I am working on a couple people to join us for the finance committee, if some maybe a couple of our newer people. So
Good,
that would
Yeah,
be helpful
okay.
to have a few more voices.
absolutely.
Yep.
Okay, thank you
Thanks.
so much.
Thank you.
Okay.
Bye-bye.
See you
care,
in
all.
church.